Thank you very much, Neil, and thank you everyone for joining us today. We know you all have a very busy schedule, and so do we. So we want to make this as efficient as possible. Hopefully, we will succeed. Give us 25 to 30 minutes to run you through our thoughts and observations on the markets, and update you on the portfolio, before we then open up for Q&A. Now, first of all, I'm very pleased to be joined today by my partner and colleague, Swathi Sheshadri, who just returned from a very interesting trip to Asia. Almost as she landed, another colleague departed. So Max is on the way to Indonesia, and Malaysia. So the team is extensively currently reconnecting in person with a lot of our portfolio companies and pipeline companies, and we have a lot of exciting observations. Not everything positive, but very insightful observations about the business environment in the various markets we invest in, and also the circumstances in which these companies are operating. For those of you who have joined us today who don't know us so well, I'm going to spend a very brief moment on an introduction to our firm. Let me just share the presentation. Hopefully, you can see this. Neil, maybe you can give me a nod.
Yep, we've got that.
So just as a brief introduction before we get into the details, as a reminder, we focus on a single strategy. That single strategy has now been taking care of us for almost 6 years. We are just about to reach our 6-year mark with a highly differentiated strategy. It's a lot more concentrated than what the competition is doing. You will see on our top names, most of the investors we talk to are not too familiar with these names. That gives us a lot of confirmation that we're doing our job. So navigating to the lesser known companies, navigating to high quality businesses which are not in the benchmark or already owned by the larger funds. 25 to 30 individual investments give us a good handle, a good control, good oversight over the portfolio. The focus is on innovation, as I mentioned. So not just AI, machine learning, renewable energy, domestic consumption themes, but more innovative themes like some of the wealth management businesses, for example, in India we invested in, or atomic force microscopy, etc. So highly differentiated businesses. And we are using extensively our network that we developed in emerging markets. Swathi will be able to talk about this, how we connect with businesses, how we learn about opportunities by really speaking to entrepreneurs extensively in the various markets, and a more private equity-like approach. So we also, although we are still small, we are just about $400 million under management. We believe we can also act as partners and engage with companies with the aim to improve things like transparency, governance, board composition, and other factors with portfolio companies. Risk management is defined by that engagement, but also by our very cautious and careful analysis on the macro conditions. So we're just now going through, yet again, as Neil pointed out, an interesting election cycle, which brings to light some of the potential vulnerabilities. As we've seen this week, some of the Adani companies falling by as much as 20-25%, which is a good reminder where the risks lie. And our ability to avoid Russia, our ability and decision to be very careful in China, but also Pakistan and Egypt, many other markets where we simply decided we don't want to take that unit of risk, has helped us to generate performance. So it reminds me of the 1975 lecture titled A Loser's Game. Often our business is about avoiding mistakes, and that's what we aim to do in the future as well. Now, we've generated about 45% since inception in NAV return. As I said, the assets have been stable and growing over time. The peer group, so relative performance has been strong. Yes, we are trading at a slight discount right now, 6.8%, still better than the competition, although, of course, we are unhappy about the discount and are working on it. We think that performance is ultimately helping us to get rid of that discount going forward. But this year, of course, again, the appetite and attitude towards riskier assets isn't there. So we're seeing that, whether it's the dollar, whether it's still the higher rates, sticky inflation, uncertainty around China, uncertainty in places like India more recently, have caused this rather conservative and cautious stance towards the emerging market asset class, which is part of the reason why we see this discount. But the outperformance, of course, is strong, and we continue to be really, really optimistic, I have to say, especially when talking to companies, especially when we spend more time on the ground. We think that it is an incredible opportunity in emerging markets, whether in Latin America, where you have still a post-pandemic recovery, very visible and becoming more evident as interest rates are falling pretty steeply from a very high level. Inflation moderating, export numbers looking quite good, capacity expansion in different industries, but also the CapEx cycle, broadly speaking, is improving. So we are optimistic here. What we are seeing, we're also optimistic, especially in Southeast Asia, where everybody's getting really in pole position to win the race towards leadership in various technologies. Automotive, of course, is one big area, with now China being the largest exporter of automobiles globally. But that whole ecosystem across Southeast Asia is exciting, including high-performance data centers, which need different materials, different technology. But then we also talked about and observe a lot the whole move towards things like smart cities, smart electricity grids, satellite technology, new communication technologies, where these businesses are developing the solutions for tomorrow. So this is our universe here. We are focusing predominantly on businesses which are, on the one hand, liquid, but then still not the biggest ones. So between 500 million and 10 billion is our main hunting ground. We've also invested in larger businesses, which we can do, but the preference is for sort of mid-cap. And we exclude what we call the sin sectors, and have, as I said, have a preference for rather innovative sectors. The investment philosophy, for those of you who have not spoken to us before, just very briefly, it's really about identifying businesses which can convince us, which are convincing us that they have deep and sustainable moats, that have been managed in a responsible way, where we see sustainable, strong margins, superior profitability, run by convincing, honest, reputable entrepreneurs. This is really the key. We spare no effort in finding out the backgrounds of people. We, as I said, spend a lot of time also on macro, and we think about investing for the long term. So we had fairly low turnover despite the volatile times, and we aim to have as little turnover as possible. Unconstrained, benchmark agnostic stock picking across the market cap spectrum is really what describes us. The typical NCP stock has a very strong balance sheet. Typically, our companies have liquid balance sheets. They have net positive cash, and they have strong return on capital. We typically invest in businesses which are growing quite fast, so we have a preference for growth. And as I said, margin leaders. We prefer industries where we see profit pools growing. We don't like dying industries. And we avoid regulation, which is why we had no exposure to, for example, healthcare or education tech in China, or why we avoided many other areas, especially in healthcare globally, where we saw more and more regulation coming in. I talked about modes. I talk about governance. Governance is something we take very seriously, and our rule of thumb is avoid mediocre, poor corporate governance from the very beginning. So instead, we prefer companies which already have strong governance and understand the interests of minority shareholders. Of course, there's always space for improvement, but we don't think that it's a plausible and successful recipe to invest in poorly governed companies with the hope that they would turn around. Talking about performance, we measure our performance in absolute terms, but of course, investors are very interested in the performance against the mid-cap benchmark and the MSCI Emerging Market Index. We've outperformed both over 5 years, 3 years, 1 year, and since inception in a significant way. This year, we are sort of in line. The first half has been choppy for emerging markets with very little positive developments in the stock markets, at least. Of course, the second half, we're quite optimistic about what we're seeing there. Q3, Q4, earnings growth expectations, demand, inventory levels actually being very low, export numbers being very positive, especially from Korea, Taiwan, and Southeast Asia in general, but also domestic consumption improving. So many factors, including also a very positive state of the semiconductor cycle overall, will drive earnings growth for the portfolio. So we expect this year to be, at least the second half, to be significantly better than the first half. Now, just before I turn over to Swathi, my colleague, who's going to talk about our recent trip, few more points from my side. Country and sector allocation. We have trimmed Taiwan along the way. We've taken quite a bit of profits. Otherwise, the weight would be even higher than what you see here. And we continue to see some of the investments we've made there, which have done phenomenally well as a source of funds for other ideas. So expect that weight to come down slightly from what we have here. India, same thing. We've trimmed India a little bit earlier this year in the first half. Certain positions which have done phenomenally well. At the same time, we've also reallocated to some new positions which we can talk about. Yes, you can find interesting businesses which are offering you very exciting growth without excessive value in the market. If you look a bit more into the sort of the mid and small cap arena. So 18% here, followed by South Korea, which is doing really well. Exports, as I said, is stronger than expected. Brazil, 10%. Turkey has done really well. We have mainly US dollar and euro-based businesses in Turkey. And then we continue to be skeptical on China. We have very, very little exposure to China. Governance continues to be a problem. And we prefer and increasingly look for businesses which are based out of China, but give us the exposure to the country that we like to have without all the negative side effects. In terms of sector allocation, it's diversified, especially software gives us a lot of diversification because emerging market software businesses have exposure to a broad range of industries, a broad range of segments within the countries. And 22% here is exactly what we want to have, especially as emerging market countries and corporates are moving into more digitalization and with a higher software content. Hardware is about 22%, healthcare 11%, semiconductors 10%. And within semiconductors, we have no exposure to the typical semiconductor companies like TSMC, Samsung Electronics, SK Hynix. We invested in asset-light IC design houses, which is quite different. Now, as a result of our work, we had very strong upmarket capture of 143 and very good down market protection. This is what we are ultimately aiming to achieve. This is the outcome of our risk management. This is the outcome of our investment policy. And we aim to preserve this as much as we can also over the coming years. And I'm very optimistic that we can do that. In terms of the top 10 holdings here, as you can see, the country is quite diversified. Korea, Brazil, Taiwan, Turkey, India, and very, very unique businesses. All of these businesses are run by founders, by entrepreneurs. All of these businesses are focusing excessively on shareholder return optimization. The average market cap here is about 3.5 billion. Growth expectations for them are very strong for the year 24 and 25. And as you can see, net debt to EBITDA, they all look very strongly positioned here. And maybe just to point out a couple of them here, E Ink has recently won yet another very large deal by Walmart to provide the business with electronic shelf labels. Elite Material has gotten a significant allocation from NVIDIA to supply copper-clad laminate, but also Apollo Tubes, which continues to be actually gaining market share in India and provides infrastructure parts to the construction industry. So all of these businesses are in really good shape. Classes has come up with a new product in a medical healthcare device, which they just launched in the second quarter, early second quarter this year. And what we really like here is that an increasing portion of the business is coming from what they call consumables. So these are materials which are needed to run the devices that they're selling globally. So across the board, really strong businesses here. Now with this, I'm really excited and pleased to hand over to my colleague Swathi, who's going to talk about Asia. And I hope, Swathi, you've recovered from jet lag.
Thank you, Carlos. Definitely recovered from the jet lag, but less happy to be here in this weather, and definitely less exciting to not be around meeting companies and experts on the ground. I wish I could spend more time there, but my colleague and I have spent nearly a month across the Greater China area, Taiwan, Hong Kong, the mainland China, visiting 8 cities. Definitely exciting to be there, meeting different kinds of companies across different sectors. These are companies in the technology sector. These are companies providing both high-end technology to the NVIDIAs of the world, but also those fabless companies, design companies, very small, medium-sized businesses, and also large businesses, which gives us insight into the whole value chain of technology, really. Was also quite interesting to meet innovative healthcare businesses across the region, and of course, consumer-led businesses, which gave us good insights into what are people on the ground thinking about consumption, what are the consumption patterns, what has been the shift in the last couple of years post the COVID lockdowns being done away with. And our visits really are around not just meeting companies, but we love to meet local economists, we meet trade officials, we meet consultants, we managed to meet some of the central bank officials, and also local fellow fund managers who probably have spent a lot more time on the ground, who understand these markets better than us to a large degree, and to hear a different perspective really from people who are so much more closer to the businesses and to on the ground changes that are quite dynamic. Carlos, if you could go on to the next slide, please. Thank you. So maybe to start off with, we can start with China, which of course has been on everybody's mind. Is the most populous or the second most populous country, depending on the numbers you look at, and has been on everybody's mind in terms of this being the bellwether of really driving the global economy to a large degree. What we hear or what we see here is, of course, that the PMI across both manufacturing and services have been around 50, which is good, which means it's not as weak as people expect, and we've seen how things have recovered post the COVID lockdowns, really. The GDP growth expectations have been moderated in the last couple of years, but we still see China sort of growing above 4%. What we noticed really was consumption in the last couple of years since the start of 23 really did pick up. We've sort of looked at what are people eating, where are they dining, what are they spending more on, going more to the movies, buying more cars, traveling more. And that sort of made us also excited about being there on the ground and seeing what really are people thinking and spending more on. What we really like in China, of course, is that it is a market that gives the largest TAM, has the long-term growth potential. It comes with a significant consumer base, both across individuals and businesses. But more importantly, China also drives demand. It drives the economies around the ASEAN region as well. And the recovery in China for us and for the world also means that the whole ASEAN region is going to benefit from this. So this is a market that can't really be ignored. And that is why we sort of do like China. But on the other hand, what we are always careful about while investing in China has been around the governance, the transparency, and the stricter regulations around most of the businesses that play into the kind of businesses that we tend to avoid. Right. So maybe these are some of the statistics, but what would be more exciting is just what's on the next slide, really, on what we observed on the ground and what are people looking at. So a few things really on the economy and what are some of the people watching would be the government 9-part plan and the third plenum, which is expected to be announced in July, which is a set of policy measures that the government is trying to introduce. Which sets the tone for the rest of the year and the next couple of years in terms of what to expect in terms of economic growth, the state interventions, the policies, the subsidies around real estate, increased capacity around manufacturing, and how the government really deals with currency and deflationary pressures at this point. All of these also means in the last few months, we've seen the Chinese market really looking better, but a lot of this has been driven by the flows into the market, while we think the fundamentals remain weak, but we see definitely signs of improvement in select pockets of China, and that is what we sort of wanted to validate as well while on the ground. Speaking of the consumer sentiment, really, which is more exciting to us to really see how the consumption has changed versus pre-COVID during the lockdown and now that the country has sort of returned to normalcy in the last year. The pressure of inflation and the state of the economy itself means that consumers have definitely sort of seen a downgrade in their spending patterns. When I say a downgrade, consumers still spend. It's not like they're not saving anymore or they're not spending anymore, but they continue to spend. But the consumers have become a lot more smarter in spending really on goods or services. It's funny how this is called the TikTok effect. And this is what we observed as well. Every customer is on their cell phone comparing every product and service and making sure that they are spending the right amount of money and are paying the right value for the quality that they get on any goods and service. For example, they would be buying, let's say, an Estee Lauder product in the past, but now they probably have a local Chinese maker making a similar product at probably half the price. So they would probably spend more on the Chinese product because it's the same quality. Sorry, I just get distracted by cosmetics, but that's just me. But this is what we really saw in terms of what the consumers are thinking. And in terms of the unemployment, really, we've read stats, but it's also interesting to know that a lot of the industrial innovation, which means productivity improvement, have come through, but the job situation, the creation of new jobs has been slower than the productivity gains in itself. And in the last couple of years, we've actually seen that 1/4 of the Meituan delivery drivers, Meituan is the Deliveroo in China, 1/4 of their drivers really actually have an undergraduate degree themselves, right? Which was interesting for us to really see. What we've also observed across some of the sectors outside of consumption and manufacturing really was around healthcare. Healthcare in emerging markets is not a sector that can be ignored. The government is still focused on healthcare as one of those sectors where they want to provide better quality healthcare to the population. but are also very cognizant of the spending on healthcare, really. And this is a sector that continues to see more regulatory interventions from the government itself. An interesting point we've noticed was also the love for Chinese to travel. You can call this revenge travel, but doesn't look like revenge travel is going away in less than a year anyway. But most of these cities we visited, Shanghai, Hangzhou, Shenzhen, we saw people across weekends and weekdays really traveling across. And this is a new driver of spending, really. It's also interesting how the Chinese government themselves are trying to promote tourism, trying to promote tier 2, tier 3 towns, which were previously not really discovered by the domestic travelers themselves, and boost tourism spending, really. And these were some of the observations, really, in China. And was, of course, definitely exciting to be back after being cut off for a while. And we do see that there are signs of improvement across segments, but it looks like it could be a longer wait. But we are this is, of course, a market that cannot be ignored, and hence we remain close to the economy itself.
Thanks, Swati. And maybe just to add, there are certainly a couple of concrete ideas we are also working on, as I said earlier, but we're not going to throw overboard our basic principles of having a very strong preference for companies with good transparency and proper governance in place, and that is reducing actually the investable universe here quite dramatically for us. But nonetheless, there are quite a lot of interesting ideas here. This brings us just to the next slide. In Taiwan, just be mindful of time. We're going to speed up here a little bit, but again, also the team was in Taiwan. There's a very strong recovery in the semiconductor cycle, and that recovery is going to last for quite some time. We're just seeing the very beginning of it. As you can see, what a lot of investors sometimes lose sight of is the sort of long-term trajectory of the semiconductor market. It's certainly been a very positive ride for the last 15, 20 years. There are, within the cycle, there are, of course, quite a lot of changes that are taking place in terms of the type of businesses which are flourishing, the materials that are needed, the technology which is deployed, quite a differentiation that is or a migration which is taking place here. So the AI market, Swati, maybe you can talk a little bit about this. I think one of the things you said is that in every meeting you had in Taiwan, AI was sort of, the word AI was mentioned right at the beginning, and there was a lot of excitement about it.
Yeah, that is right. And it was not just in the meetings. It is funny how I think every conversation with the local taxi drivers is also around NVIDIA and how they can gain exposure to NVIDIA's supply chain through some of the Taiwanese companies. Carlos, if you could move to the next slide, please. Of course, AI is on everybody's mind, and this is Taiwan. You can't really get people to stop thinking about semiconductors in general. And I was there 6 months ago as well. And this time, I think the enthusiasm around AI, but also generally new technologies and semiconductor and the recovery that we've seen there was quite palpable. It was also interesting to see how the sentiment has changed in the last couple of quarters, really about visible signs of recovery being seen across businesses. It could be companies in the testing business. It could be companies that actually make chips or design chips that work with the large customers, the small customers. It was across the chain. Right. And of course, when it comes to Taiwan, geopolitics is on everybody's mind. But if any one country can be as resilient in managing any risk, it has to be Taiwan. They continue to recognize this as a risk, but the customers cannot do away with the technology and the engineering talent that they find in Taiwan. And they continue to work closely, actually, with these businesses, saying, how can we mitigate this risk over the longer period of time? They're not saying they do not want to work in Taiwan, but saying, okay, how can we sort of diversify your manufacturing facilities to nearby regions where it works for the customers, as well as the largest ecosystem that is there in Taiwan. We were actually in Hsinchu, which is like the Silicon Valley, which is another city in Taipei, in Taiwan, which has the most of the foundries of TSMC. It is funny how this city was actually created to make space for the fabs by literally cutting off the hills. Because they needed that ecosystem to be there, and it's fascinating just to be there. And that is what we've noticed really in terms of our observations in Taiwan. In the interest of time, maybe we can just move ahead. And this is a recent company that we've added to the portfolio. We've met them a couple of times. What was interesting is that this looks like a very small company that's under the radar, but they are among the top 3 global manufacturers of sockets and connectors that go into the motherboards of laptops, desktops, and servers, right? They've been around since the late 1980s, and they're one among the largest companies today offering these very niche components that go into pretty much anything that has a CPU at the end of the day. What was interesting for us was we've met them in the past, and on the next slide, you'll see this time we wanted to build more conviction on what they do really, which is why we went into their manufacturing facilities, into their R&D labs, to get a feel for the kind of products, but also to get a feel for the kind of equipment that they use, what really gives them the edge in terms of the people that they work with or the kind of equipment that they use, and how do they differentiate themselves from their customers, from their competitors, and be very close to the customers and continue to innovate and do well over the next 5 to 10 years. That is what we wanted to really share on our findings from Taiwan, Hong Kong, and China. In the interest of time.
And if I just can interject here, so as I said, just to relate this to the country weight and our stocks and exposure to the country, as a reminder, we have a sort of an almost radical policy towards having asset-light businesses in that country, which are global. These businesses are global. They're listed in Taiwan, but they operate all across the world. Their clients are global. They're highly specialized, extremely profitable, very flexible businesses with very good governance. I mean, we walk away with such a good feeling about these businesses as minority shareholders, how they, positively think about optimizing operations, improving profitability, cementing margins, and all the rest of it. So it's really a very positive experience as investors to be working with these medium-sized operations out of Taiwan. That brings us to a very hot topic, Swathi. Do you have enough energy to cover India?
I definitely have energy, but I don't have enough time to talk about everything that I want to talk about India. You can't get India out of an Indian. You can get an Indian out of India, they say. But anyway, speaking of the fiscal situation and the monetary policies and GDP growth rates is something that we've known for a very long time, and nothing really has changed in the year to date. It's only strengthened. In terms of the fiscal prudence of the government, really, revenue collections continue to improve over time. Businesses are quite positive. I'd spent the first few months of the year really in India and continue to meet businesses even as early as just on Monday, in the midst of all the drama around elections. But what would be interesting really is the saga around the elections. After 6 weeks of polling, really, in probably one of the hottest summers that India has seen, finally the counting was done on Tuesday, and we've all read about the news around who forms the next government. There was, of course, nervousness. I probably haven't slept for 2 days before that. But what was really the expectation of the market was to see if the current government continues. It was more of continuation in the policies. This has, of course, been a pro-business government, and what created nervousness was really about the loss of seats or the loss of the majority that the government enjoyed in the last couple of terms, which is the last decade, sort of reducing now, where Modi-led party, which is the BJP, needs to rely on a few allies of their own to form the majority government and to continue to make these reforms. What one should really notice is that BJP still is the dominant party, so there's no way that they cannot be part of the government. And coalition governments in India, the alliances in the past decades really has worked really well for India. The Indian parties really know how to navigate policies, the government regulations, and be more focused on economic growth, even within these little alliances that they do form, right? One interesting point to note is that really the alliances or the NDA, which is the smaller parties who would now join BJP to form the government, don't really influence the economic policies or the reform agendas to a large degree, which is set by the majority party. So the Modi-led BJP party would still be the dominant party that would continue to make these policies. And the allies who would be joining them, actually one of them has probably been a pioneer in bringing reforms to one of the smaller states in southern India. So you can call him Modi 1.0, and Modi actual would be Modi 2.0, right? So they've all been pro-reform parties themselves, and that is sort of what has also calmed the markets, where we've seen the volatility over the last 2 days. So we continue to be excited about the government's reforms in the future, but also the country itself, the economic growth and what businesses are doing on the ground, and also individuals and their consumption power are dramatically improving over the years, continues to make us confident of the market and the kind of opportunities we see in this market.
And
I'll stop there.
And to add a comment on this, obviously we are being very cautious on valuations in India. We think that there are certain areas which look certainly red hot, and as you know, the local investor community is very greedy. So the good news is that they're typically chasing two hands full of names, and they leave enough on the side for us to discover before the rest discovers it. So we've had quite a bit of changes to our Indian exposure over the last 12, 18 months. We've added a number of holdings, which like 361, which is the largest independent wealth management business in India. We continue to be very optimistic about Persistent Systems, which is an IT consulting firm. And as I said, APL Apollo, with a view on ongoing infrastructure developments in India, new airports, train stations, public and private infrastructure. We think that they are in a very good position to continue to grow earnings. And we see the multiples we are holding here, it's still quite reasonable.
Well, thank you, Carlos and Swati, for your time today. Really appreciate the run through, and thank you all for joining for the update as well. Swati, welcome back. I'm sure you hit the 52 degrees if you were in Delhi. Welcome back to 52 degrees Fahrenheit if you're in the UK now. It's good to hear your optimism for the rest of the year and the periods ahead. And as I said at the start of the presentation, many congratulations to you and the team on your recent A rating award by Citywire. Very well deserved, having seen 5-year figures come through last year as the top performing fund in the AIC Global Emerging Markets sector. On top of that, it's clearly an incredible opportunity to consider your exposure to emerging market equities at this time. And the shares today are trading at 6.8% discount to NAV compared to a 3-year average of 2.76%, just looking at the AIC data on their website at the moment. Peel Hunt are the brokers to the company, so please do approach your normal Peel Hunt representative for interest in flows. If you would like a further one-on-one meeting, do reach out to myself or your normal Frostbro contact. And equally, if you'd like to see one of us at Prospero independently, do also reach out to us. This is Neil Winwood signing off. See you next time. Thank you.
Thank you.
Thank you.